I'm Jen Kohls of Richardson Financial Group, and I'm here with Dan Brown, our Director of Investment Management, and we're here to provide the economic and investment update for October 2023. Looking back in October, both stocks and bonds declined. While stocks were broadly lower for the third month in a row, small caps were the worst performing asset class.
And the primary catalyst for the negative returns that we've seen for the last couple months has really been the rising interest rate environment. We talked about it last month, and we're going to talk about it again because interest rates keep rising. So just to look at the U.S. 10-year Treasury, for example, it actually peaked above 5% late in the month of October. So this was the highest level of interest rates that we've seen really since 2007. And just to put that in reference, the U.S. 10-year Treasury began the year at about 3.8%. So again, a pretty dramatic rise in interest rates, and this has negatively impacted really the whole financial market, whether it's stocks or bonds. So Jen, you mentioned that stocks are down 3 months in a row.
Mm-hmm.
We now have seen fixed income or bonds down 2 months in a row, and we see many fixed income benchmarks in negative territory for the year. And we wouldn't be surprised if they remain there for the rest of the year as we think interest rates will continue to remain elevated.
We're halfway through third quarter earnings season, and so far the results have been encouraging. Dan, what has been the response of the financial markets?
The response has been fairly muted. As we talked about earlier, investors are just keenly focused on the level of interest rates and the path of interest rates. But again, as you mentioned, Jen, results are very encouraging. So earnings are beating by about an 8% margin. But again, investors are really just keenly focused on interest rates. And as we look out for earnings for 2024 estimates, we still think they're too high. So right now, analysts are projecting about a 12% growth in earnings in 2024 over 2023, and we still think that's too high because we expect to see some slowing of economic growth. And again, it all comes down to the higher interest rate environment being a headwind.
Third quarter GDP grew an impressive 4.9% annual rate, the fastest rate of growth since fourth quarter of 2021. Dan, do you have any further insights or takeaways you'd like to share about that report?
Yeah, so that report came in a little bit higher than expectations. Estimates were about 4.5% growth in the quarter. And as you mentioned, it came in about 4.9%. And as we look into the components of growth, that's what kind of surprises us. So, we're 2 years removed from COVID, and we see the consumer spend at the strongest pace of the last 2 years. So the graph we're showing here, the top half is just, the overall GDP numbers. So you can see that 4.9% growth rate. But if you look at the bottom part of that graph where we're showing the component for personal spending, again, you can see how strong that was. And again, we're a little surprised that the consumer is spending at the pace it is, even though we're a couple years removed from COVID. And we're a little bit concerned about that going forward, just because we think the consumer, for the most part, has kind of spent down all those excess savings that they built up during the COVID period. And if we look at this GDP report broader and what it means for the financial markets, again, it all comes back to interest rates, and we do have a Fed meeting November 1st. And if we think about what it means to the Fed, it probably means that they pause at this next meeting. Again, they've done a lot of work over the last 18 months, but we think the Fed continues to message that interest rates are going to remain higher for longer, which again, in the short term, is probably going to continue to be a headwind for the financial markets.
With all that said, Dan, has our future outlook changed?
The outlook is still fairly cautious with our discretionary managed portfolios. And again, it all comes back to interest rates. And we think to get more interested in the stock market specifically, we're going to need to be fairly confident that interest rates are going to kind of level out here and continue to stop rising at a fairly aggressive clip. And a lot of that comes back to the Fed. We think the Fed is mostly done raising interest rates. We could see one more rate increase from them. But again, we're going to need to see interest rates kind of level out here. And what it means for the portfolios, we're still underweight stocks relative to where we've been, say, 2 years ago. We continue to be attracted to money market funds that are now yielding over 5%. And we're starting to become more interested in traditional fixed income. Again, interest rates have produced a negative return for fixed income year to date, but going forward, we think the opportunity in this setup is fairly attractive.
Thank you for sharing your insights, Dan, and thank you for watching. If you find value in watching our monthly videos, click like and subscribe below.